1:52 p.m. The envelope is still in your hand. You are 24 years old. FICO 720. 3 years of student loan payments, everyone on time, no collections. The card arrived today. Visa Platinum, $5,000 limit. Your name pressed into the front in silver. Lighter than your keys. 191 million Americans carry at least one credit card. The average APR is 24.99%. 78% of households live paycheck to paycheck. None of that is in the room with you tonight. You have a 720 and a record that says you are the kind of person who pays what he owes. The balance is 0. The limit is 5,000. The space between those two numbers feels like room to breathe. 4 years from now, you will owe $4,000. 12 years from now, $850,000. The machine did not start when you opened this envelope. It started 6 weeks ago. An algorithm in a data center in Wilmington, Delaware pulled your file, calculated your acquisition cost, and decided the offer was worth sending. The compound interest clause sat in paragraph 14 of the agreement, 8-point font. You did not read paragraph 14. No one does. Level 1, the balance builder. You are 24 years old. Salary, $52,000. After taxes, after the $340 student loan that drafts on the 15th, after rent, take-home is $2,870 a month. The card goes in your wallet behind the debit card. Emergencies only. That is the agreement you make with yourself on the drive home. The first charge is $47. Gas station, Tuesday. You were just short that week. By March, the balance is $4,000. The flight to Nashville for a friend's wedding. The suit. 90 days of food delivery during the project that kept you at a desk until 10 p.m. The $600 you wired your sister because she asked and you had the limit. Statement loads on your phone. Minimum payment due, $94. You pay $94. That month's interest charge is $83.11. Principal reduced, $10.89. The statement does not show you this arithmetic. It shows you a green check mark. Someone decided what to surface and what to bury, and decided correctly from their perspective. 11:48 p.m. on a Wednesday. You run the number yourself. Minimum payments on $4,000 at 24.99%. Time to pay off, 23 years. Total interest, $5,847. The dress shirt from Nashville is already in a donation bag. The debt will still be here when you are 47. You close the app. Done. 3 days later, an email arrives. Subject line: you may qualify for a personal loan at 11.9%. Level 2, the consolidator. You are 27 years old, 3 cards. Chase $8,200. Capital One, $6,700. Discover, $4,500. Total, $19,400. Combined monthly minimum, $490. Combined monthly interest, $404. You hand over $490 and move $86 of actual principal. SoFi approves in 48 hours, $22,000, 11.9%. 60 months. Fixed payment, $489.06. You transfer all 3 balances on a Friday, 3 zeros on 3 separate screens. Something in you unclenches. It feels, specifically, like being forgiven for something you can't quite name. That feeling has a shelf life of 19 days. Week 3, client dinner. The corporate card declines. You put $640 on Chase because someone has to. Reimbursement takes 11 business days. By the time it hits, you've used the card twice more. Balance, $2,100. The Chase account never closed. An open zero balance card lowers your utilization ratio, lifts your FICO, keeps you inside the acquisition band for the next product. The system grasped this sequence completely. You did not. Right now, a debt-to-income algorithm at 3 separate lenders is processing your updated profile, silently. DTI, 28%, still green, still acquirable. Consolidation didn't retire the debt. It decanted it into a cleaner bottle and left the original lines open. Progress. If you've stayed this far, this channel exists for exactly the person you are right now. One subscribe keeps the analysis going. Back to it. Level 3, the restructurer. You are 31 years old. The marriage lasted 4 years. The divorce cost $14,000 in attorney fees, split between 2 cards and a personal check that took the last of savings. You were just short in a way that has a specific weight at 3 a.m. on the ceiling. Lightstream approves $35,000 at 14.49%, 60 months. $28,000 clears the cards that refilled since SoFi. Monthly debt payment, $1,840. Salary, $78,000. After taxes, after $1,840. After rent, after the car payment, you have $610 left for the month. FICO, 684. Not a crisis, a direction. You discover balance transfer cards, 0% APR, 18 months. You move $6,200 from Chase to Citi, $200 transfer fee. Paying $344 a month to clear it before the rate resets to 26.99%. You read the fine print. You have a plan. Month 4, brake pads and 2 rear tires, $680 on the Citi card. The plan absorbs the exception. Then another. Your daughter turned 7 on a Saturday in April. You confirmed the party 2 weeks before. A client situation runs from 9 a.m. to 3 p.m. You arrive at 4:15. The other children are gone. She is at the kitchen table with your mother, finishing the last piece of cake. She doesn't say anything about the time. She shows you her presents instead, each one lifted with both hands held out toward you like evidence. You do not examine this closely. 6 weeks later, your bank calls. A real person. $47,000 in home equity. HELOC rates more favorable than personal loan products. She uses the word favorable twice. You listen. Level 4, the homeowner. You are 35 years old. HELOC approved at $180,000. Variable rate opening at 8.75%. You use the house as a variable in an equation. First draw $110,000. Lightstream, gone. SoFi, gone. One payment, one lender. You also put $18,000 into Ethereum at $2,300 a coin. The Lexus replaces the paid-off 2017 Honda. The Lexus costs $687 a month. 6 credit cards still carry $42,000. You didn't clear those with the HELOC draw. You meant to. Total obligations, $340,000. Monthly interest alone, $2,470. Not principal, interest. You drive Uber Saturday mornings, 8 a.m. to 2 p.m. In March, your wife hands back your phone after you showed her a photo and the Uber driver notification is sitting on the lock screen. She doesn't raise her voice. She asks one question. You answer it. The silence after lasts 4 days. The plant on the kitchen windowsill dies in April. Terracotta pot, trailing vine, had been there since the 2 of you moved in. You don't replace it. You don't examine why. The Ethereum hits $4,100 in November. You don't sell. By February, it is $890. The position is worth $6,900. You paid $18,000. When you secured the HELOC, you converted unsecured consumer debt into collateralized debt. A card issuer who goes unpaid has friction in the process. A lender holding a lien on your house operates under different rules. The collateral is the house. The house is where you sleep. It is in paragraph 11, 8-point font. If this analysis is useful, one subscribe keeps the next scripts coming. Level 5, the ceiling. You are 38 years old. 14 credit products. HELOC drawn to $162,000 at 9.4%. 6 credit cards carrying $74,000. 2 buy now pay later accounts from the kitchen renovation. Total obligations $850,000. Monthly debt service $5,340. Salary $94,000. Take home $5,890. $550 a month for everything else. FICO 512. The Bank of America card, $14,000, misses the first payment in August. Timing was wrong. A gap between a freelance payment and a paycheck. Day 180 of non-payment. Bank of America classifies the account as a loss, charge-off. They write it off and take the tax deduction. The debt does not disappear. It gets sold. 3 weeks later, a letter arrives from LVNV Funding LLC, Post Office Box, Greenville, South Carolina. The name at the top is not Bank of America. They paid approximately $840 for your file. 6 cents on the dollar. You do not know this yet. Then the garnishment notice arrives, a Capital One judgment entered in county court. 25% of disposable wages withheld at payroll. Your manager will find out. Tuesday in October, Walmart parking lot. You turn off the engine. You sit for 47 minutes. Not on your phone, not crying, just sitting in a car you still owe $11,400 on before going inside to do a job that now pays you 75 cents on the dollar. You type 3 words into Google, bankruptcy lawyer near me. Level 6, the discharge. You are 39 years old. The office is on the 2nd floor of a strip mall in Garland, Texas. Nail salon left, tax preparer right. The attorney charges $1,800 flat. She has filed 2,400 of these. Means test. Your trailing 6-month income falls below the Texas median for a household of 2. You qualify for Chapter 7. Liquidation, not restructuring. The petition is filed on a Tuesday at 9:14 a.m. At 9:14 a.m., the automatic stay activates by federal law. Every collection call, every garnishment, every letter in the postal system stopped. Your next paycheck is whole. The 341 meeting is 5 weeks later. Trustee, not a judge. 11 minutes. No creditors appear. They rarely do. Discharge arrives 93 days after filing. $720,000 in unsecured debt, legally extinguished. The HELOC remains. $130,000 secured against the house. Collateral does not discharge. Chapter 7 was codified into federal law in 1978 because the system that extends credit requires a release valve. You are using it the same way you used the Visa in 2009, a product with defined eligibility, available to those who qualify. You qualified. Done. There is a person who did not appear in any of these levels. His name is Marcus, 42 years old, VP of Acquisitions, Encore Capital Group, San Diego. Encore is listed on the NASDAQ. Last fiscal year, the company collected $1.8 billion from people who owed money to someone else. Tuesday, 11:48 a.m. Marcus is reviewing a portfolio. 40,000 charge-off accounts originated by Citibank, seasoned 180 to 360 days past due. Total face value, $94 million. Encore's bid, $5.6 million, 6 cents on the dollar. Marcus has not called any of these people. He employs 1,400 collectors in Manila, working a contact schedule his analytics team has been calibrating for 11 years. The scripts are reviewed by legal. The pressure is precisely dosed. Enough to produce payment, not enough to produce a lawsuit under the Fair Debt Collection Practices Act. On each dollar collected, gross margin is 34 cents. The return on a fully worked portfolio runs 2.1 to 2.6 times the purchase price. Your Bank of America account is in a different portfolio. Smaller buyer, Atlanta. They paid $840 for your file. You were line item 7,441 in a batch of 12,000. No one said your name. The file moved as a row in a spreadsheet. When a court enters the deficiency judgment, that judgment is a durable asset. In Texas, it can be pursued for 10 years. The statute of limitations on the underlying debt is 4 years. But if they file suit inside that window and win, the clock resets. It accrues interest at 8.25% per year, compounding while you are focused on other things. For 15 years, you understood your situation as a conflict with the bank that issued your card. The bank sold your file the same quarter they charged it off. They made 6 years of interest income, recovered a fraction at sale, wrote off the remainder. You were not the loss. You were the yield. The entity now pursuing $14,000 paid $840. Their cost basis is 6 cents. Everything above is return. You were not a borrower in their model. You were an acquisition. 11:52 p.m. somewhere right now. Different kitchen, different counter. She is 24 years old, FICO 720, Visa, $5,000 limit. Her name in silver on the front. She doesn't know her file was priced 18 months before she applied. Inside a risk model that estimated her expected lifetime revenue to within $200. She doesn't know the minimum payment on page 3 was designed in 2003 by behavioral economists and has not been changed since because the number was tested and the number works. She makes the first charge on a Wednesday morning. Coffee, $4.75. The machine does not stop. It just finds new borrowers.